If you bought tips to protect yourself from inflation a few years ago and then watched them get crushed when interest rates went up, you are not alone. Millions of investors learned the hard way that the most popular inflation hedge in America is not actually a pure inflation hedge. PIMCO just launched an ETF designed to fix that. It is called the PIMCO Inflation Plus Active ETF. It trades on NASDAQ under the ticker PCPI. It launched on April 6, 2026, run by PIMCO, the largest active bond manager in the world. PCPI is built to give you the inflation protection of tips, with much less of the interest rate pain that comes with them. So how does it actually work? PCPI focuses on short-term Treasury inflation protected securities, the part of the tips market with the least sensitivity to interest rate moves. On top of that core, PIMCO actively layers in other inflation-linked instruments and management overlays to enhance the real return. The result is a portfolio that still tracks inflation, but with shorter duration and lower volatility than the broad tips funds most people own. But here's the catch they do not put on the homepage. PCPI is brand new. Assets are still very small, around $20 million at launch, which means the spread you pay to trade it can be wider than a giant fund like SCHP or VTIP. Liquidity will improve if assets grow, but it is a real cost on day one. There is also the active management cost. PCPI runs at roughly 33 basis points, low for an active fund, but still meaningfully more than passive short-term tips ETFs that charge under 10 basis points. You are paying PIMCO to make active calls on which inflation-linked bonds to own and how much duration to take. That can add value, or it can quietly underperform a cheaper passive fund. There is no free lunch. Why does this catch exist? Because actively managing inflation-linked debt is a real specialty. PIMCO has been doing it for decades and is one of the few shops with the depth to do it well, but no manager wins every year. You are buying expertise plus structure, not a pure index trade. Performance is too new to judge. PCPI just launched. But you can look at PIMCO's broader inflation-linked track record and the long-running performance of short-term tips, both of which show the same pattern. Short-term tips hold up much better than long tips when rates rise, and PIMCO's active overlay tends to do its job when inflation surprises to the upside. So who is this fund for? It is for investors who want a real ongoing hedge against inflation, but who got burned, or do not want to get burned, by the duration risk inside funds like TIP. Retirees protecting purchasing power. Allocators who want short-duration inflation exposure, or anyone uncomfortable with the way classic tips funds behave when the Fed is hiking. Honest caveat. This is not a yield product. The headline distribution will be modest. The job here is to keep up with inflation while taking less interest rate risk, not to pay a fat coupon. If this was useful, smash like, hit subscribe, and tell me in the comments. Would you ditch your traditional tips fund for an active short-duration version or stick with what you have? See you in the next one.